Well, I think the silver thing is a potentially big thing that some people might call a black swan, but it just looks like the math working out. So we get a squeeze in silver. Another thing that might come along with that is something similar in copper, because that market is pretty tight. The yen carry trade, which we've already talked about blowing up, is a potential. Again, it's a black swan to anybody who's not paying attention, but it's a very big possibility as a crisis out there. And the biggest thing of all, though. Well, I wouldn't want to commit to any kind of analytical conclusion, but that is an ominous chart. I mean, anything that gold follows upward is usually a bad thing, because gold is a barometer of stress in the global financial system. So it could be something as simple as Japanese interest rates going up, people watching that, getting more and more worried about what it does to the yen carry trade and to the Japanese economy directly, and buying gold in response. Gold is where you hide out from things that are unpredictable and disturbing. And spiking Japanese interest rates are the definition of unpredictable and disturbing. So yeah, it could just be that gold is telling us that the higher Japanese interest rates go, the closer we get to some kind of a financial cliff. And you want to be in real money when that happens, not a fiat currency that has to be inflated away in response to some kind of a crisis. So, I mean, your and my investment thesis from all of this has always been that you want to be in precious metals and other kinds of hard assets. And this chart just shows that a lot of people have made the same decision.
Historically, December is quiet for gold and silver. Yet this year, both metals are showing unexpected strength. Gold recently surged far beyond typical resistance levels, briefly topping $4,000 before settling into a surprisingly mild consolidation. Normally, such a dramatic run sparks heavy profit-taking and volatile pullbacks, but not this time. The reason? Central banks. Their steady buying, motivated by long-term reserve strategies rather than short-term pricing, has created a soft floor beneath gold. With central banks accumulating tonnage, not chasing dips, gold's stability suggests deep structural demand, hinting that a larger monetary transformation may already be underway.
Yeah, because you've got to remember, the interest rate chart is essentially an inverse of the bond value itself. So the lower the bond value goes, the higher the interest rate goes, and vice versa. So when we're looking at this chart, we're really tracking the gold price moving in conjunction with the diminishing of Japanese debt. And of course, you could actually look at this from the TNX, from the U.S. 10-year yield. It's not as profound as the Japanese 10-year yield, but there's a bit of a pattern here. The gold did move in tandem with the U.S. 10-year, but the 10-year yield on the U.S. side has been moving sideways for a while now. But let's go ahead and take that off, and let's look at gold in isolation here. It looks like the precious metals are getting ready to heat back up again. And what's odd is that it's in December. December is usually a very seasonally slow news month for the precious metals. Here's gold. It looks like we're consolidating here right now. Silver's moving up. But what do you make of this recent move in gold? Is this a consolidation pattern we're seeing here?
Well, gold had a hell of a run. And you would expect actually a much bigger correction than we got, because it blew through $3,000 an ounce and then through $4,000 an ounce, which created a lot of profits for people to protect. So it wouldn't be a surprise with a chart like that for a lot of people to take profits up above $4,000 an ounce, and for it really to knock down the price of gold. That doesn't happen is probably because central banks are the whales in this market right now, and they're not price sensitive. They are tonnage sensitive. They've been ordered to accumulate X tons of gold, and so they're buying it regularly without worrying about the price, because that's not the issue for them. So we're getting a consolidation here, but not a very big one, not the kind of stomach churning correction that chases weak hands out of the market. So, as long as the central banks are steady, if not aggressive buyers, then that kind of puts a floor under gold, because you've got big people who have monetary printing presses who apparently need to accumulate a lot of gold. And then look over at the crypto guys, and you've got entities like Tether that are setting up gold-backed stablecoins, and they have to buy a lot of gold and store it to back those stable coins. And Tether is now, in terms of the amount of gold that it owns, it's up in the central bank range there. It's comparable to brand name country central banks. And it's just one stablecoin company. There are probably several others that are thinking about jumping with both feet into the gold market, because that's a really logical kind of stablecoin product there. So you've got a lot of really non-price sensitive buyers in the gold market right now. And that doesn't mean gold goes straight up from here, but it means that the wind is at the back of that metal's price. And that explains why we're not seeing the volatility that you would normally see in this wild bull market like we've otherwise seen for gold. So I don't know what to draw from that, other than the gold thesis is still intact. We still might see some corrections out there, but it feels like there's a repricing going on. There's kind of a monetary reset going on in the world right now, and it's unofficial. But a lot of fiat currencies are being swapped for gold, obviously, with central bank buying like this. And there's a goal in mind for that at some point. The end game somewhere out there is for a lot of central banks to be able to back their currencies with gold. And we'll have to see how many of them actually do something like that in an explicit way. But I think that's part of the story going forward for gold and for silver, that there's a monetary repricing happening, and we're going back to the old kinds of money that can't be inflated away. And that's a very good thing for gold and silver one way or another.
A new player has entered the gold market: digital stablecoin issuers. Companies like Tether are now backing their tokens with physical gold, accumulating reserves on a scale comparable to national central banks. This introduces a wave of non-price-sensitive buyers who acquire metal purely for collateral strength. Their presence, combined with aggressive central bank purchases, has dampened the dramatic swings normally seen during gold bull markets. At the same time, many countries appear to be quietly preparing for a future in which gold may again anchor currency value. This slow, unofficial monetary shift suggests gold's long-term repricing is far from over.
Well, I wasn't in the room where the cooling unit lives, but the coincidence is pretty extreme. I mean, when you got silver making a historic move, literally something that it's never done before in nominal terms, and that's the moment that the exchange goes down. I'm not a technician. I wasn't there.
Here.
I don't know anything, but
right there. That's Friday is that big green bar. We're just shot all the way up.
Yeah. So exchanges tend to do things to limit volatility in the commodities that trade on the exchanges. They'll change margin requirements in a way that makes it less attractive to hold futures contracts, things like that. And so it could be that this is in the same category as that, but it was something that happened on the spur of the moment, and it was kind of an emergency thing. It was something that was derived more from panic than from any kind of policy, but I don't know. And the fact that silver wasn't really fazed by it, although silver's down today, so maybe we've got a delayed reaction happening today. But at the time, silver wasn't phased. A lot of people didn't pull out, and volume didn't crash, and silver didn't go back down another couple bucks an ounce. It just held on to an all-time high. That's a good sign. That means that people are interpreting the commodities exchanges playing games as a sign of weakness rather than a sign of strength, and which they should. I mean, that when commodity exchanges do things to stop trading, that means they're worried about what's happening if they don't stop trading. And that is a very big sign of weakness. That means they don't have the metal on hand to make good on all the claims on that metal that are now trading on their exchanges. So, I mean, and that's the case. It's kind of a fractional reserve banking system in the metals markets, especially silver, where there are claims that dwarf the amount of physical metal that's available for delivery. And so you can't have all those claims stand for delivery because the metal's not there. So they're doing things to prevent that. And I suspect at some point they fail, because the industrial demand for silver is so high and rising, and the supply of silver coming out of the world's mines is inadequate for the industrial demand. And then you've got monetary demand happening at the same time. As gold goes up, silver gets pulled up via the gold-silver ratio, and there's just not enough silver to satisfy all the potential claims out there. So I think everybody's watching this with interest, because everybody in this market can see the math, and the math is very unfavorable for the exchanges and great for silver. So seeing that, if you're if you're General Dynamics and you need silver for missiles, you're going to go out and get as much silver as you need for the next few years' projected demand, right? Because you're not going to stop supplying missiles to the Pentagon or to any of 50 other countries that are buying from you, just because you couldn't get enough silver, or the price of silver was too high, or something like that. You're going to satisfy your customers whatever you have to do to get the ingredients for the systems that you need to put in your missiles. So spread that across the entire industrial economy, and you have a lot of stockpiling going on, maybe. Once again, in the face of a big deficit and shrinking above ground supplies. So we're getting close to the point of some kind of a squeeze in this market, where somebody takes a huge amount off the market. That causes some turmoil at the exchanges. That causes everybody else who's in the same boat as that first big buyer to panic buy, and then silver goes to who knows where. As the saying that's going around now goes, it becomes unobtainium. You can't get it at any price, and there are some people who just have to have it. So it'll be interesting to see what all this elasticity stuff does to the market when we find out that the supply is inelastic, and no price is going to get you what you need. So we'll see. I mean, there's a good chance that something like that happens. We don't know when it happens. We don't know what the sequence of events will be, but we're creating the conditions in which there's a massive short squeeze in silver, and you basically want to be there for that, right? You want to have your stack created and stored in the right place, because that becomes a life-changing event for you if you're heavily invested in physical precious metals, as everybody should be who's listening to this.
Silver recently made a historic leap, reaching chart levels never seen before. And at the very moment the metal exploded upward, a major commodities exchange suffered a sudden shutdown, an uncanny coincidence that raised eyebrows. While technical explanations exist, many traders see the outage as a defensive reaction to extreme volatility. Silver markets have long operated under a fractional reserve-style system, where paper claims far exceed available physical supply. With industrial demand rising sharply and available inventory shrinking, buyers are becoming more determined. If a large industrial or sovereign entity suddenly removes massive volumes from circulation, a true short squeeze becomes possible.
Well, I think the silver thing is a potentially big thing that some people might call a black swan, but it just looks like the math working out. So we get a squeeze in silver. Another thing that might come along with that is something similar in copper, because that market is pretty tight. The yen carry trade, which we've already talked about blowing up, is a potential. Again, it's a black swan to anybody who's not paying attention, but it's a very big possibility as a crisis out there. And the biggest thing of all, though, might be the Fed easing aggressively, which it's already getting ready to do. Trump is getting ready to replace Jerome Powell as the chairman of the Fed with one of his guys, some of whom have been explicitly talking about a big drop in the dollar's value and much lower U.S. interest rates. So let's say we have the Fed do that, but the bond markets don't play along. In other words, the Fed cuts interest rates, but long-term rates go up because the bond market is not buying this story anymore.
That happened last year.
And then that means that's right. On a relatively small scale, though. Rates went down at first when the Fed started cutting, and then the 10-year yield went back up to kind of where it was before. But it could be bigger this time, where it spikes to some unmanageable number. And then you got everybody looking at the government's interest expense, which is now $2 trillion, and that dwarfs the military budget by 50%. That kind of thing. When you see that kind of math on CNBC and CNN, then people get seriously spooked, and nobody wants to own the bonds of a country that is running those kinds of numbers. So something like that is conceivable in 2026. And if that happens, then that means we're kind of at the end of the fiat currency experiment. So this is potentially very big for economic history. We tried this experiment starting in 1971, where we trust governments to effectively and honestly manage our currencies. And they basically screw it up on an epic scale. And so over the next 50 years, we become more and more deeply indebted. The 95% who aren't super rich become debt slaves to the 5%. And we end up with civil unrest on the streets and in the financial markets on a scale that we've never seen before. So anyhow, that could all happen. I'm not saying it does, but it's a very plausible scenario. And then you get, of course, the monetary reset. So we're, unless we keel over with heart attacks in the next couple of years, we are going to live through that part of monetary and financial history, which is fascinating on the one hand and absolutely terrifying on the other hand.
The global financial system is showing signs of strain. U.S. interest costs now exceed $2 trillion annually, overshadowing even military spending. As political transitions loom, markets expect aggressive monetary easing, yet long-term bond markets may refuse to cooperate. If the Federal Reserve cuts rates while long-term yields rise, confidence in the dollar could falter fast. A scenario like this, combined with the possible unwinding of the yen carry trade, would challenge the stability of fiat systems worldwide. Such pressures could accelerate the shift toward hard assets like gold and silver as nations quietly prepare for a future monetary reset.
Well, yeah, you're right that it feels recessionary in a lot of ways. You look at student loan payments that are, there's defaults are spiking in that market, and credit card debt is spiking, and the average interest rate on credit cards is through the roof. So you got all those people carrying balances that are quickly going bankrupt. And it goes on and on. A lot of different sectors in the economy look like we're already in a recession. But meanwhile, you got the government running massive deficits, and you've got the electrical grid being built out as kind of a national interest issue now. It's sort of kind of a wartime footing, where we've got to spend trillions of dollars on building out these. Oh, wait, I have to go back for a sec. One other possible big thing in the next couple of years is the AI bubble bursting. And because it turns out that, we don't need all the AIs that are being built, and they can't do a lot of things that we expect them to do in any event. And because of that, a lot of the AI companies are not worth anything like what they're now valued at. And then that pulls the stock market down, yada, yada. That's a possibility too. But we're not going to let that happen without a fight. We've still got to build a lot of new nuclear plants and a lot of new gas-fired fired power plants and probably lay down a lot of new solar panels. And then we've got to wire everything up to get that power from wherever it's created to wherever it has to be used. You need a lot of copper for that. So it could be that the economy is, let's say, lackluster in 2026. But the demand for copper continues to rise because we've got this once in a generation power grid build out happening that the government will finance if it has to. And so, that's the copper goes parabolic story. And we'll have to see. But I think that, yes, you've got a lot of risk in the copper market that you may not have in gold and silver because the monetary reset thing is so imminent for them. But I still think copper is a thing to own because so many of the plans we're making right now and that we're not willing to give up depend on electrification, and copper is crucial for that. So it's it's the definition of a critical metal, and I think that's good for demand for it and potentially good for its price.
While fears of recession grow, seen in rising credit defaults and consumer strain, one sector remains poised for powerful demand: copper. Massive investments in electrical infrastructure, new grid systems, AI-driven data centers, and renewable energy are turning copper into a critical resource. Even if the broader economy cools, governments are committed to electrification and energy security, ensuring copper remains essential. Meanwhile, an AI bubble, built on inflated expectations, could eventually burst, dragging equity markets with it. Yet through all potential volatility, one theme persists. The world is moving toward real assets, scarce materials, and metals that cannot be printed or replaced.